Hi everyone, it's Jack back with another video, and today I'm going to be talking about a pharma company that doesn't get a whole lot of attention for the one that has a $154 billion market cap, and that is Bristol-Myers Squibb. As I said, $150 billion company that not nearly enough people know about. Only recently, a couple of years ago, completed an acquisition of Celgene, which is another very big name, for $74 billion in total. Cancer and immunotherapy company. Obviously, huge and resilient market opportunity just in the acquisition of Celgene's products, in addition to its own back catalogue and pipeline. It pays a nearly 3% dividend yield and has done so consistently over the longer term. And it, interestingly, has outperformed the market quite significantly. The S&P 500 is down about 12% year to date. This company is up nearly 17% year to date at the time of recording. Decently off its 52-week low of $52. Even at its near 52-week highs of $72, it's still price earnings ratio of 24 on a trailing basis. Seems reasonably valued, so I want to dig into its most recent results and then have a look at the valuation, future prospects, etc. Once again, if you like liking the videos, please like and subscribe, help the channel grow. Let's get into it. First up, a relatively high-level summary for the quarter. From an operational standpoint, relatively strong commercial execution in my opinion. Q2 sales just shy of $12 billion, up 2% year over year. Of course, this doesn't really tell the full story. That's 5% year over year, excluding foreign exchange, which a lot of companies are struggling with at the minute and is clouding results. Double-digit earnings per share growth and continued growth for inline products and strengthened momentum for the new product portfolio, which is quickly growing. Pipeline execution terms, they have a few key milestones that, again, this is a very complicated sector, so I'm not going to go too into this, but they have a few programs that they're pushing, a couple of approvals that they're pushing in the US and Japan by the end of the year, some applications under review, and a psoriasis drug that could possibly be a blockbuster approved by the FDA yesterday. Financial strength, they're adjusting the gap and reaffirming non-GAAP guidance for full year 2022. We're going to look at that later, but reasonably strong. Balance sheet strengthening, of course. They bought Celgene a few years ago. They bought Turning Point Therapeutics for $4 billion in an all-cash deal, but it's a very free cash flow generative business. So they're doing decently here. $6.1 billion year-to-date cash from operating activities, and they have about $13 billion in total cash and marketable securities. The balance sheet is in a decent place, but again, we'll go into that a bit more. So looking a bit more in depth into those revenue numbers, as I mentioned, nearly $12 billion in sales, 5% excluding foreign exchange. The vast majority of that is from inline products, which is $8.7 billion for the quarter, up 9% year over year, 13% excluding foreign exchange, which is very, very good performance in my opinion. The new product portfolio recorded around $500 million in sales, and those two asterisks essentially mean there's greater than 100% growth year over year. These are very new products and they're growing like a weed. Fantastic to see the pipeline is really pushing because they're losing some products. The recent LOEs that is down 22% year over year, 20% excluding foreign exchange, so down 2.7 billion. So the new product portfolio is not making up for this fast enough, but it is doing a decent job of it. The new product portfolio sales performance, while coming from a relatively low base compared to the rest of the business, is experiencing tremendous growth, over 100%, up from $225 million in revenue to $482 million in just 1 year. Quarter on quarter, excluding foreign exchange, they saw a 38% growth, which is absolutely staggering. A lot of these names on the bottom, please don't make me try and pronounce them. They're experiencing over 100% growth, many of these, and this is just really impressive. A relatively varied bunch. They've also the anticipated approval, as I mentioned at the bottom, that was approved on the 10th of September for a psoriasis drug. Again, please don't make me try and pronounce that, but all of these combined are going to be the future of Bristol-Myers, they would like to think. I think this is positive that they're building a good base and showing that the pipeline is moving and producing results relatively quickly. And if they continue this even close to this growth, this is going to become a very significant section of the business very, very quickly. Going a bit deeper into those earnings, 77% gross margin is a slight reduction from the previous year, which is 79%. I think this is to be expected with all the problems that 2022 is bringing. Of course, there is the supply chain challenges that have only increased year over year, increased energy challenges that they're going to be affecting a large multinational like this for sure. Their operating expenses were down slightly year over year, which is a positive. Their effective tax rate was also down this year, and the diluted earnings per share was up slightly, and with an overall reduction in diluted shares outstanding. This also me seems absolutely positive. Nothing that knocking out of the park. I'm not overly impressed with the gross margin, but it's still very, very high. There is no real red flags here for me. What is very important for me, particularly for pharma companies, as they often take on big acquisitions, like this company did with Celgene, where it requires a decent amount of debt. This company has around $40 billion in debt on the balance sheet, so it needs a balanced approach to capital allocation, not to just continue to pay and increase the dividend rapidly, return cash to shareholders, which it is doing both, but it's doing both in a sustainable way. $42 billion in debt and $13.2 billion is cash is not an incredibly impressive position, but this is a very, very free cash flow generative company. They predict that between 2022 and 2024, they're going to generate between $45 billion and $50 billion in free cash flow. So they're going to continue to pay down that debt, maintain their strong investment grade credit rating, which is absolutely something they need to do, but they believe they can balance this with small acquisitions like the one for Turning Point Therapeutics, replenishing and diversifying the portfolio, paying down the debt and returning cash to shareholders at reasonable rates. They're going to continue the dividend growth as they have done for many years. It's now around 3%, which is completely sustainable in my opinion, with a decent payout ratio, and opportunistic share repurchases. It's not an incredible valuation right now because this company is up compared to the broader market, but I imagine when it's down, they still have $10.2 billion of remaining authorization to buy back shares after already buying $5 billion back in Q1. So I believe probably by the end of the year, they will have spent some more of this. One thing that concerns me slightly, not for the longer term performance of this business, but for the very short term, I wasn't overly impressed with the guidance. They revised the guidance in July from the prior April guidance, and that was a slight reduction in earnings per share on a GAAP basis. Total net sales were looking at being slightly down, and the inline products and new product portfolio was down around $500 million from what they were expecting, so a low double-digit increase, which again is absolutely fine by me. A low double-digit increase it was still going to be a low double-digit increase regardless, but it's just not overly impressive in my opinion. I would like to see a bit of a stronger performance from this company. However, I'm not going to ding it too much. The large majority of this revenue is the inline products, and I don't think that's going to change that much. Looking at some balance sheet and profitability metrics, cash debt ratio, as I mentioned, 0.31. It's actually okay for the pharma industry. It's not ridiculously bad, but it's very poor for Bristol-Myers Squibb's history or recent history, and that's mainly because of the Celgene acquisition. And I think I have said enough about its balanced approach to capital allocation and what I think of that. I think it's taken an excellent approach. I think there's a very strong management team in place here. I think this debt load will be paid down. Whether the cash to debt ratio increases, that remains to be seen, because they have a plan for the capital allocation and they don't necessarily need 10% of market cap in cash on hand. However, I think the debt load will come down significantly in the future, and I'm absolutely fine with that because this is a very free cash flow generative business and it has decent interest coverage. With this year's EBIT, they'll be able to pay 7 years of interest, which is not amazing, but it's pretty good. So I think that Altman score is actually a little unfair. An Altman score of 2.54, I don't believe it is anywhere near a risk of distress. I think this is an absolutely fine company from a balance sheet point of view. From a profitability point of view, 80% gross margins and 79%, very, very strong. In the most recent quarter, 77%, still absolutely exceptional, not only for this industry, but for any industry and for Bristol-Myers Squibb's history. This is a management team that are executing very, very well. Operating margins of 20%, again, very, very strong for the pharmaceutical industry, and a net margin of 14% is very good for the pharmaceutical industry. They have a 19% return on equity percentage, which again, very, very strong for the pharmaceutical industry in my opinion. And a return on invested capital percentage of just under 9%, which is not amazing versus the wider investment world, but I think for a company of this size and scale and this industry is very, very good. And I'd be quite happy owning a company with these sort of metrics and this sort of balance sheet. Looking at some basic valuation metrics, on a trailing basis, PE of around 24, but on a forward basis, expected to be around 9, which is far below the S&P 500 averages, and a very impressive versus its peers in the pharmaceutical industry. A PEG ratio of around 3 is not incredibly impressive, but I'm predicting that the new product line is going to surpass expectations in my opinion. I think this makes it reasonably valued on a PEG ratio basis. I'm not really happy paying three times for a PEG ratio, but it's not absolutely ridiculous by any means. Price free cash flow of 11 is thoroughly cheap in my opinion. Anywhere below 20 for me is reasonably valued. 11 is right in the cheap range, and again, it's below S&P 500 averages. And finally, a discounted cash flow calculation to work out its intrinsic valuation and thus the fair value to pay for this stock. On an annual rate, it has grew its free cash flow 11.6% every year for the last 10 years, which is absolutely excellent on average, of course. I think a more conservative estimate is 5% because I like to be conservative when buying a company of this size and scale with this debt load. So using a 5% free cash flow growth rate, which I think is absolutely realistic for this company if its new product portfolio pans out as I expect it will, and is far more conservative than its recent history and more in line with its 10-year revenue growth actually. Terminal stage of 4% and a discount rate of 9% for the long-term returns of the stock market. This gave a fair valuation of just shy of $88 compared to a present-day stock price of $72, so around a 20% margin of safety, a decent premium over the present-day stock price, and I'll be more than happy buying this company for these prices. Of course, you should do your own research and due diligence, see what you think of this company. Its payout ratio is a little high on a dividend basis, but I think this is still a reasonably good dividend stock and has paid out for many, many years now. I think it's a reasonable company at reasonable valuations with good growth prospects, a less than stellar balance sheet, but it is very, very free cash flow generative, and I think it will pay down its debt. And if it follows its balanced capital allocation approach, I think this could be a very, very good business to hold over the longer term, particularly for retirement. However, of course, this is just my opinion. You should do your own research and due diligence, and let me know what you think of Bristol-Myers Squibb. Let me know if you think it's a pick of a stock, or let me know if you think it's an underappreciated stock like I do. Like and subscribe and enjoy the video. I'm of course not a financial advisor, and once again, you should not buy this just because I'm saying I think it's a good stock. You should form your own opinion. I'll see you next time.